Hey everybody, we are going to talk about some of our favorite stocks that have all the qualities that Warren Buffett would love to see in a stock, except their size. He can't buy enough to really make a meaningful difference for Berkshire. Before we dive in, please take a minute and check out fool.com/Frankel, the link you see on your screen. Get the top 10 stocks to buy right now from the Motley Fool. They are our sponsor, and it's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, Tyler's joining me. We're big Warren Buffett fans. We've actually traveled to Omaha. Tyler's traveled a lot further than I have to get to Omaha for the Berkshire Hathaway meeting. Both big fans of the investment style. We both, I don't want to say model our portfolios after Buffett's principles, but there's definitely a lot of influence there, I think it's fair to say, for both of us. So Berkshire has that massive stock portfolio everyone follows. It has even after selling half of its Apple position, has about $300 billion worth of stocks in it. Companies like American Express, Bank of America, Coca-Cola, and the list goes on and on. The big theme is that Buffett stocks tend to be large companies. The reason being he needs to be able to buy enough that it makes even if he's right, it's going to make a difference in the context of a $900 billion market cap company. He can't buy 5% of $1 billion company. Even if it's a 10-bagger, it's really not going to be a big needle mover for Berkshire Hathaway. So when we say stocks that Warren Buffett can't buy, it's not that he can't buy them. He certainly could. Buffett could invest in a a micro cap stock, but he wouldn't, because even if he's completely right, it's not a big enough deal for investors. So Tyler and I are each going to talk about one stock that we think would be in Buffett's portfolio if it were just 10 times its current size. So with that in mind, Tyler, what are you looking at first?
Yeah, I want to go with like unique assets, right? And one of the things that certainly it seems to always fit what Berkshire Hathaway wants to do, but it's one place where they tend to not go too much, and that's in real estate, and specifically real estate investment trusts, and that's kind of by design. Like you said, like they can't buy enough to really move the needle, but because of the way that real estate investments trusts are structured as trusts, Buffett is really limited, or anyone is really limited to how much you can buy of the company, because there has to be a certain amount of shareholders, and you're only limited to. It's very low. It's more than five, I think.
So, no,
It's not
so
high.
with REITs, because I'm going to be talking about one too, no single shareholder can have more than 10%, or the official rule is no five shareholders can own 50% of the stock. So in practice, they limit the ownership of any individual shareholder to 10%. When Buffett owned Store Capital, for example, it was the stake hovered at 9.9% the entire time.
So the company that I mentioned, Rexford Industrial, it's an $11 billion company. He owns like 10% of it's $1 billion. I mean, that's a rounding error for Berkshire Hathaway. Like the juice isn't really worth the squeeze. But for us individual investors who don't have to manage $900 billion worth of money, hey, it could actually be worth something. And I really like the unique asset component of Rexford Industrial. It is, as the name implies, an industrial REIT, which means distribution places, warehouses, light manufacturing facilities, things like that. Um, but it's very unique in the sense of like it focuses exclusively on the Southern California, kind of that Los Angeles, Long Beach, all the way down to like San Diego sort of area. And while that does sound kind of small, it's larger than all of the other real estate or industrial real estate markets in the United States combined. If it was a country by itself, it would be the fourth largest industrial real estate market in the world. It's huge. And so there is ample opportunity within this seemingly small playground for Rexford Industrial to go. And it's also one of the most lucrative. If we look at it right now, across all of the LA County area, average rents are considerably higher. Vacancy rates are below 4%, when the national average, I think, is about right around 7. And Rexford in particular has been really, really good at this because, LA, it's a growing city. There's not a lot of room left for industrial real estate, and stuff gets zoned out. So you have a lot of infill, or just kind of like a shrinking supply. And as a result, they can raise rents pretty quickly in this market, which typically leads to much, much higher growth over time. And just to give an example of this, over this past quarter, their comparable rent rates, so like when somebody's lease expired and they signed a new one, comparable rent rates increased by 67% this quarter, and was on a GAAP basis, and 49% on a cash basis. So the rent, when these leases come due, there's a whole lot of more money coming in the door from these, because it is such a lucrative market. They've also been very good about finding things in this very hot market still at good rates. A large proportion of what they buy is called off-market buys, where it's basically like they know the market so well and they've been talking with so many people in the industry that when something comes of it, before it even like goes to market, they're gobbling it up at considerably better rates than what you could probably do if you had to go through a real estate broker. And so you have, in my opinion, probably one of the best industrial real estate companies in the country. And it has shown. I mean, the market hasn't exactly liked this stock for recently. Its dividend yield is somewhere near its 10-year high, but this is a company that's grown its dividend over the past 10 years at an annualized rate of 13%. So, I'm willing to sit on something like that that's going to grow at that kind of rate.
Yeah, I have a similar, not similar, but it's another real estate company, Ryman Hospitality Properties. Ticker symbol is RHP. They're roughly $6 billion market cap company. So again, way under the realm of where Buffett would be interested. But there's a lot to like about this business. It's a great income generator. It's actually been one of the best performing REITs of the past year and a half or so, in a terrible environment for real estate stocks. Ryman Hospitality, they are, as the name implies, just like Tyler's, the name tells the story. They are a hospitality REIT. They have two main businesses. They have hotels. They own all 5 of the Gaylord hotels. They're in Nashville, DC, Colorado, Texas, and Orlando. And they also have a few other hotels. They're all big group-focused hotel businesses. They focus on conventions, conferences, things like that. Massive properties. And a big differentiator between those and other hotels is they make the majority of their money from spending outside of hotel rooms, food and beverage, conference space, things to that effect. They also have an entertainment business called Opry Entertainment Group. They own some of the most iconic country music assets, the Grand Ole Opry and Ryman Auditorium, which is where the company gets its name. It also owns the Ole Red Entertainment and Dining venue chain that just opened a big location on the Las Vegas Strip, if you've been there lately. Now, it's in the COVID pandemic, Ryman's revenue just kind of collapsed. No one was going to hotels. There was really nobody going to hotels that normally had conventions and conferences and things like that. It was so slow that they voluntarily shuttered one of their hotels for, I think, almost a year at one point. Their occupancy was in the single-digit percentages for a while, and the stock plunged. Everyone thought, no one's going to gather again. No one's going to, have group-focused business again. And boy, were they wrong. The group-focused hotel businesses, or like conventions and things like that, have really come roaring back more than anyone thought they would. There's a lot of pent-up demand for people to get together and collaborate and things like that. And you could actually make the case that with the surge in remote work, that things like that are more valuable than ever. Tyler and I both work remotely. We've traveled considerable distances to actually be physically with colleagues and things like that. So now with so many more people working remote, it's actually really more valuable than ever to have these kind of properties. And you can see they're in the most recent quarter, Ryman's revenue was the highest it's ever been. Operating income, average daily room rates, adjusted EBITDA also at all-time highs. The company increased its full-year guidance. One concern is not. I mean, not just that Ryman has debt. All REITs have debt. They have a pretty reasonable debt level. They're investing heavily in their properties to try to capitalize on this. They're adding rooms to some of them. They're renovating older rooms and convention spaces. They're adding convention spaces. They're investing a lot of money. I think close to $1 billion in the next few years that they are investing in their properties. That's a lot for a $6 billion company. But if the current trends keep up and people keep having conventions and conferences and things like that, this is a great company, great economics to this business. It's got a very reliable 4.3% dividend yield that is well covered by its earnings. And I think it still looks cheap. It's trading at 12 times full year or FFO, the real estate version of earnings. So still a cheap stock despite how well it's done recently. I like both of these calls. Tyler, thanks for discussing some real estate with me. It's always fun to have, the other Fool.com contributor that likes real estate stocks. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.